You can bet against a stock without the infinite risk of short selling, using 75% less capital than the pros require. Shorting 100 shares of a $200 stock requires $10,000 in margin and carries unlimited risk. The poor man's covered put does the exact same job for roughly $2,500. It's a diagonal debit spread that acts like a synthetic short position with a predefined max loss. Instead of borrowing shares, you buy a deep-in-the-money leaps put, usually expiring in 12 months or more. This long-term contract acts as your collateral, replacing the need to short the actual stock. But here is where 90% of traders fail. If you don't pick the right strike prices, a sudden rally destroys the trade setup. You need to calculate the net delta to ensure your long leg gains value faster than your short leg loses it. We call this the 70-30 rule. You need your long leaps at roughly an 80 delta, and you sell the short-term put at a 30 delta. This positive spread pays for your time decay while you wait for the stock to drop. If the stock tanks, your leaps explodes in value. If it stays flat, the short puts generate weekly income to lower your cost basis. It's the only strategy that lets you profit from a crash and stagnation simultaneously. Stop gambling on crashes. Start renting out your downside.